This week, we're covering the unwind in crowded AI trades, the Fed decision, and big tech earnings. The S&P 500 sits just 2.8% below its all-time high, but that masks real carnage under the surface. Through Wednesday, Goldman Sachs' U.S. high beta momentum basket had fallen 39% in July, its deepest monthly drop going back to 1999. While some of the hardest hit AI names are now rebounding after Microsoft's strong earnings results and weeks of hedge funds unwinding crowded positions, the past month's damage has been severe. To better appreciate the extent of the crowding and unwind, UBS baskets tracking AI winners against losers swung by nearly 47 percentage points to the downside in the US this month, the largest reversal on record. The pain is also global. Korea's Kospi index, in which Samsung and SK Hynix comprise roughly half the value, fell about 38% from its June peak. While AI infrastructure spending is exploding, competition is also rising, including from China, and chip firms are increasing their capital spending, giving rise to some concern about the durability of their pricing power. By comparison, the value factor beat momentum by more than 9 percentage points in July, the widest monthly gap since the financial crisis. This goes to show the importance of portfolio diversification and anchoring portfolios in companies with stable cash flows and durable outlooks, rather than concentrated bets on a single theme that may have features of cyclicality. Shifting gears, the Federal Reserve held interest rates steady at 3.5 to 3.75% at this week's FOMC meeting, but the vote was 9-3, with all three dissenters preferring a hike, and markets leaned toward a move higher in September. With longer-term Treasury yields approaching 20-year highs, the bond market is signaling that it's worried the Fed remains behind the curve on inflation, and it's not giving Chair Warsh the benefit of the doubt as he starts his term. Within tech, cloud earnings have been the bright spot. Alphabet grew cloud revenue 82% year over year, and Microsoft's Azure grew 43%, its fastest pace since 2022, with demand outrunning supply across the industry. The stock reactions have come down to spending discipline. Meta and Alphabet fell after boosting spending plans, though we think Alphabet remains in a sound position. Microsoft, which is up 15% as of this recording, had more moderate spending and showed revenue acceleration, giving investors confidence that it will be able to inflect back to strong free cash flow generation. At roughly 22 times forward earnings, we don't view the stock as expensive if growth like this continues. Please let us know if you have questions or feedback. Thank you and have a great weekend.